All right, well, we'll go ahead and get started then. For those of you who it's your first time joining us, I'm Lindsey McKay. I'm a lead advisor at McKay Wealth Management, and we do quarterly economic updates where we invite speakers from different parts of our world, so portfolio managers, economists, people that are in it every single day, to talk about what's been happening as far as the markets and the economy, but also what are we expecting to happen. On the horizon. So I know that all of you are very interested in the topic since you joined us today. So I don't want to take up too much of the time. So I'll go ahead and turn it over to Kezia Samuel, who's joining us today to give us the perspective from her team and her part of the organization that, uh, like I said, not only thinks about it from the economy and the markets, but also doing a lot of the portfolio construction. So with that, I will turn it over to you, Kezia.
Thank you very much, Lindsay. Thanks for all of you for taking time out of your busy days to join us. I know we have no shortage of headlines to unparse, make sense of. It feels like one day to the next are two very different flavors, and the market's reaction have been equally fast moving. So hopefully we can unpack all of the headlines and see why markets are doing what they're doing, and see what's next for the economy as well. So I'm going to share my screen and just making sure I'll make this bigger as well. Hopefully this is coming through clearly, Lindsay. If you could just give me a verbal yes.
There you go. It looks good.
Fantastic. Again, thank you for having me. I'm going to be, for the next 30 minutes or so, just quickly unpacking the economy into three different segments. I am going to stop and take a quick look at the markets, and sort of reflect on where they were. You'll see that the numbers are already dated. They're about 20 days from 20 days ago through the end of the first quarter, so the first 3 months of this year. Sort of a quick look back, but clearly, this current month of April has seen a very different flavor. So we'll talk a little bit about why that is. And then I'm going to pivot and spend the bulk of our conversation today on the economy. What's the underlying drivers of economic growth? Are we seeing slowdown as a result of higher oil prices? And how should we digest the impact there? And then last but not least is the thought leadership section, which essentially is our take on what are the opportunities, but also what are the risks and how are we managing to mitigate those risks. So let's dig in. Here's a quick look at the markets on the left-hand side table. You can see the YTD is year to date. Again, that's only the first 3 months of this year. So as of March 30th, 1 year and 3 year. I'm going to start with some comments around the equity markets with the S&P 500, which is the most common benchmark for the US stocks, was down 4.3% through the first 3 months of this year, but essentially taking a nosedive during the month of March when the war started. But since then, as of Friday's close, the S&P 500 was up 4.5%, so almost a mirror image of where it ended, but on the opposite. So plus 4.5% through last Friday's close, and today was essentially a flat day. So what took this big reversal? Part of this has been the narrative around the war has shifted from a potential for an escalation with an unknown outcome to a still uncertain, but looks like both parties, it won't be smooth, but wants a de-escalation ramp. And so that's kind of the key narrative the markets have sort of globbed on, and you have seen markets quickly give away losses and sort of lean in on gains. You can see international markets, which started the year with a banner start, outperforming, gave away so much of those gains. Why? Because of the chart on the right-hand side. When I say international markets, these are stocks both in Europe, Japan, which are the developed international index, as well as stocks in India and China, which make up the emerging markets. So look at the chart on the right-hand side. You can see during the month of March, when the war started, Countries that are more reliant on importing oil saw greater drop in their stock prices. No surprise. They were likely going to be hit more. So countries like Japan, Germany, China, which tend to be much more reliant on imported oil for economic growth, saw their stocks drop much greater in comparison to Brazil and US, which are net exporters, meaning not only do we have enough oil for our own economy, but we also export it. So you could see those segments of the stock market did better. But since the de-escalation or the peace talks have come back into the forefront, international markets have once again come back and beat the US stock market. So the international develop is up roughly 8.5% as of Friday's close, and emerging markets is up 14.5%. And we'll talk more about why that is, why we've seen these big shifts back and forth. But again, the talk of peace has shifted the narrative. What about bonds? Bonds have done what bonds do best. They're providing the income within the portfolio as well as the diversification. They were flat or 0% for the year to date, and now they're up roughly 1% as interest rate expectations have normalized. They haven't quite risen the way they did during the war. Gold again took a big pause during the war, despite uncertainty and inflation fears. And I'll talk more about that, but gold is up roughly 12% year to date, and a globally diversified 60-40 portfolio. That moderate risk client is up 3% as of last Friday's close. You can see, again, a 5% shift from being down 2.3 just 20 days ago. So a big narrative shift from what we saw for the first 3 months post the war starting to now this great hopes of peace. But as I mentioned, we've gone from escalation to uncertainty. So let's unwrap that uncertainty and what that means for the economy. I'm going to start with the US economy in regards to what drives the US economy. It's a $30 trillion dollar sized economy, so it's very hard to unpack it. Drivers of economic growth in the United States. That's what's shown on the left-hand side. It is consumers. I call it my Friday night visits to whether it's Target or Costco or whatever shop you like, as consumers consuming all different kinds of goods and services drives the majority of US economic growth, followed by the two which are sort of tied together, essentially businesses and government. They're tied, as you can see, but certainly pale in comparison. The last thing that's shown in negative is trade. We essentially import more than we export, and that hurts our economy. And so you could see that has been sort of a drag on the US economy for a very long time. What we're going to do is unpack each of these three areas to see where they stand in terms of helping or hurting the economy. On the right-hand side, we look at each of these three's contribution for the last 2 years of growth and a couple of different narratives that I want to pull out from here. What I'm showing you here is in 2025 is in dark blue, and gray is 2024. You'll see that in 2025, growth slowed to 2.1% in comparison to the 2.8 that you saw in 2024. What slowed in 2025? Consumers and businesses, yes, they slowed, but they kind of did relatively similar, in the same size area, at least positive. But the two things that really shifted the narrative was government, and we know DOGE cuts were a big part of the slowdown in government spending. And so you could see that sort of really took a chunk out of the 2025's growth. And then we also saw trade, meaning tariffs hurt less. And so it was a net less negative component of the economy. So what can we expect for 2026? We're anticipating roughly 2% growth, which is what we call as long-term trend growth. How did we get to this 2%? Which means that it's likely going to be like 2025, just modestly slower despite all of the narratives so far. And so let's start by looking at where each of these three areas of the economy is. I'm going to start with the consumer. And with the consumer, we have to look at higher gas prices and what that would mean for the economy. So you can see here, we're showing you on this table two different outcomes. If oil prices stay between that $75 to $80 range, it takes the economy and cuts it by 0.1%. Not much of a drag. And that's because, again, we are a net exporter of oil. Also, we need less oil to grow the economy. Our cars are more efficient. We just need to use less to produce the same 1% unit of growth. So today's world is very different than the 1970s. But if oil prices do jump to that $100+ for 1 year and stays there, then you can see the hurt to the economy starts to become more meaningful. It sort of take a 0.3% cut in the economy. So the key thing that we're watching for is not a shock to oil prices, but a sustained elevated price. And right now we have seen oil prices sort of jump to 120, drop back to 90, and then now sitting right back under that $95 or so. So we're seeing quite a bit of fluctuation, but the key to watch here is not just the prices, but the time and how prolonged they stay. And for now, as long as it remains contained, then the hit to the economy can be contained. That's the key to watch here. But today, the consumer, as you can see here, in order for someone to feel comfortable to spend, they've got to have jobs. And again, this is a bit dated here. This on the chart on the left-hand side looks at the monthly number of jobs that are being added. And you can see it's sort of a very mixed bag. Bars on the top means we've added jobs. Bars on the bottom means that we've sort of lost jobs. And we've also shaded an area in light blue across horizontally. And what that essentially tells us is the average number of jobs that needs to get added per month in order for unemployment rate to stay steady. And you can see it's just below 50,000. So if you keep adding monthly jobs of roughly 50,000, the unemployment rate will stay the same. In the month of February, which is what we're showing you here, it had a big contraction, but March was a big positive month. Net net, we are seeing companies on average really not hiring, but also not firing in mass, which is why the unemployment rate has stayed at this 4.3, 4.4 level, and it's not quite moving. We're starting to see in the technology sector some more layoffs, but nationally speaking, it's relatively steady. And that's because of net immigration. We have fewer workers. And so those that are employed, companies are trying to hang on to them, at least for now. Now, against this backdrop of a no hire, no fire type of an environment, look on the right-hand side. This is where I think the narrative between Main Street and Wall Street break down. We look at consumer spending, as I mentioned, as our number one driver of economic growth. So when we chart what are consumer spending, it's in the blue line. It seems that they have not stopped spending. It sort of looks like it's sort of moving along sideways. But we also charted behind it in the light, sort of what looks like gray/pinkish area is consumer sentiment, how we feel. If it's green, we feel good. If it's sort of that grayish pink, we don't feel good. In fact, consumer sentiment hit all-time low historically last week. It's a survey-based estimate, and consumers are saying we don't like the economy. But when I look at the spending and I look at how we feel, those two things are not aligning. One of the reasons why the stock market has looked past what the sentiment surveys are showing versus the actual spending data. So far, the consumer is hanging in there and continues to be relatively strong, given that the job market is, again, no hire, no fire zone. But there are some cracks we're watching for. And I think the consumer that we see, when I speak of them, they're not one big monolith. There are what we essentially call as two different cohorts of consumers, the sort of the lower end, lower income earners and the higher and median income earners. And you find that here that you can see this chart here looks at delinquency rates across a variety of different loans, and especially in that severely late. So in fact, 120, 150 day plus delays. And you can see that's starting to rise. It is nowhere near where we saw in 2008, but the direction is starting to rise. So what we're finding is that lower income and younger workers, where unemployment rate is higher, are starting to show cracks, especially when it comes to some sort of delinquency problem. But here's the kicker and why markets may seem callous about it. When we look at lower income's contribution to total spending, the bottom 20% contribute less than 10% to total spending, whereas the top 20% contribute nearly half of all spending. So the top half is okay, and they continue to spend, which is why the markets have continued to stay on. So first part of the three-part equation, the consumer is doing okay, except for the lower income side. And we're again watching to see if that crack develops into the other income cohorts. So far, so good. What about businesses? That's the next segment we're going to look at. And here, the key theme that sort of driving the narrative has been AI spending. Here's five companies that we've showed here. We sort of gone back and forth between 5 and 6 companies, but 5 companies here, and what their spend is annually for 2026, roughly $650 billion in spending just on AI infrastructure, data centers, electric demand, etc. And then 2027 is even higher. I want to put some context because when you throw 650 billion, sometimes you don't quite get the scale of this number. 650 billion is the total amount that the country of Japan will spend on its economy. That's how much is being spent across these 5 companies. So to give you the scale on the impact of this, in fact, the numbers are so large, you can see the actual impact on the US economy itself. Look on the right-hand side pie chart. Last year, through the first 3 quarters, 40% of economic growth came from AI spending alone. And we don't see this train slowing just because look at the chart of the bars on the left-hand side, that AI spending is a huge boon to the economy, at least here in the near term. So speaking of what's the translation for the spending, look at the profit margins of these companies across big and small companies. So on the left-hand side, we track as the line goes up for both of these colors, profit margins are sort of sitting very, very close to its peak. And so companies are making hand over fist money. What we have seen, though, that the narrative has shifted in terms of where AI spending is coming from. In the past, these big companies were cash flush, and they were using cash to fund AI in regards to whatever they were building. Now we're starting to see that the cash has sort of been depleted. They're not cash poor, but has been depleted, but they're also taking on debt. And this is a moment where we need to be a little bit more selective in knowing the strength of a company's balance sheet. And gone are the days where you could just mention AI and you would see the stock soar. Markets are being a bit more selective around who are the winners and losers in this space. But in regards to businesses, the key narrative, if I were to take the key takeaway here, is that AI spending will be the boon, and we continue to see that being a driver for not only 2026, but also into 2027. So that's the second key driver. What about government? And in government here, I think the key thing that we were watching for and continues to be the story is the big, beautiful bill, OBBBA, and its impact. And we're just showing you one part here. This is the no tax on tips, overtime, all of those things. They were retroactive as of January 1st, 2025, but nobody changes their W-2 in the middle of the year. So we know that that would have come as a form of a higher tax refund. So shown on the left-hand side is 2025's refunds, and then you can see 2026 refunds sort of really jumps up, and that's because, again, people are going to say, hey, I paid extra taxes, and the anticipated, we just got the latest reports from the IRS, that the average tax refund is roughly $3,500 or 11% higher than the prior year. And you could see that that will carry that little bit extra money. One thing that Americans are really good at when given extra money is spending it. And so that should provide some cushion against higher gas prices. Now, we will talk about how much cushion is available, but that's what we have. But clearly, this tax cut is not a free lunch. You could see this essentially front loads the spending, and as a result, the impact on our federal debt is higher. two lines being shown here without the tax bill being passed, and then with it. You can see the OBBA line is much higher. So the impact to our federal debt continues to be in the wrong direction. So far, we've been able to sort of sustain this, but at some point, this is something that we will need to discuss further. But for now, politicians are likely to ignore it, given all of the other dynamics that I mentioned. But I do want to talk about how much cushion can this bill provide against higher gas prices? And we've done this a very simple chart here. It's one of my favorites, which sort of just looks at if gas prices stay at $3.10, which was sort of the national average before this. Now we're sitting at right around $4. Depends. For all those of you in Washington, it's a different price altogether. Elsewhere, I'm using a national number. But if it jumps to 370, you could see the benefits get truncated. We get 65 billion less than the original full amount. And if it stays at $5 for elevated time period, we've essentially wiped away this benefit. Again, we have this cushion to sort of support the consumer that, especially on the lower end, that is struggling, but it is not an unlimited source of support, which is why, again, the markets seem to be a bit giddy in that it does, if it's short-lived, and we've got this boost, it should be able to balance itself out. So that's on the government side, the impact of the tax bill, both from both the consumer as well as the companies. There's some corporate benefits in there, should be helpful to the overall economy. I'm going to hit one more thing on inflation, and then we'll switch to sort of where we like parts of the marketplace. On inflation here, you can see on the left-hand side, sort of seen a big right direction, at least from 9%, where we were at the peak of sort of the COVID days. And since then, we're now at 2.4%. But what would higher gas prices do? And here, I want you to take your eye to the bottom first, right underneath the line chart. And what we've done is x-rayed how inflation is constructed. And we've highlighted two areas for you here. Shelter, which is the biggest component of the inflation basket, no surprise. Your mortgage or your house is the biggest part of your bill. And so it is the largest portion of a CPI basket. Energy is roughly 7%. So you can see they're not one and the same. However, here's the kicker. What we're seeing is that shelter costs where you live, home prices have basically stagnated, at least nationally. Some areas are different, but stagnated nationally, and starting to see some relief, especially in rental prices, as we've seen a supply increase in that arena. That should be able to offset some of the energy price increases. However, energy is not a one stream mechanism. Higher energy prices will flow to higher transportation costs for food and other areas as well. So when we think about oil prices, even though it's only 7% of the basket, its impact is a bit bigger than people may estimate. So on the right-hand side, we show you again the same two indicators, $75 to $80 for oil versus 100. And you can see the impact at 100 for a sustained period is meaningful. And this is why the Federal Reserve is likely to remain on hold. We have some added drama that Chairman Powell will be exiting in May, and Kevin Warsh, who is sort of the leading contender for taking his seat, is going to be in the hot seat for making decisions. But it's likely that the Fed will be on hold until we have a bit more data to make decisions on interest rates. So with all of that, where do we stand on our growth and inflation outlook? Where we stand is we've got three colors, essentially to simplify. Green is being good, gray in the middle is sort of neutral, and then the red is sort of, our cautionary tale. We're not in the cautionary tales, but we have pulled back our growth because we recognize that the risks that I outlaid are there. Not enough to sort of say we're in a recession or we're heading in a recession, but certainly sort of causes us to give a pause in our outlook from where we started this year. And the same thing on inflation. We don't think we see 9% inflation return, but the direction potentially could be derailed, causing the Fed to stay on hold for longer as a result of this latest oil crisis. Against all of this, I want to pivot now into our last segment about how do we invest in a market like this. And I start with this chart. this is the unfortunate part of sort of being in the human race, in that you could see here war and geopolitical conflicts are unfortunately part of the course. It seems that we quite haven't learned our lessons. And you could see the blue line, which represents the S&P 500, has been able to often look at geopolitical conflicts as a short-lived narrative. Unless the shock is prolonged, it tends to focus on other things if it knows that this is unlikely to be sustained. So that's the first part, just some perspective around. We have seen so many of these headlines. Again, the markets may seem callous, but this is one of the reasons why. Another reason is when I look back at historical, more recent conflicts, and I sort of take a snap back here in the near term, when I look at the pattern of the markets, I find that in the short term, the markets are nervous. And you can see here, we're looking at just at oil shocks. And you can see the first 2 months, the markets in the gray zones represents the ranges and the blue dot is the average. It kind of waits for clarity. And then when I look at a year out, it starts to have a more positive trajectory. And then 2 years out, it seems to be a forgotten note, sadly, on that prior slide that I have. So again, oil shocks historically have been temporary. And again, the US economy being a net exporter of oil and consuming less oil as a whole to produce 1 unit of GDP growth sits in a very different moment, which is why it may seem very odd for why is the market rallying. The other part of why the market rallying of my second favorite chart is this one. When we talk about the stock market, we often get confused. And why do we invest? And I ask this question of clients, and they often say, to make money, Kezia. Yes, but how do we make money? We make money when we know that companies can grow their earnings or their revenues. And the way we track this is what I call as my truth moment. This is what we as market strategists and portfolio managers look for. On the right-hand side are the three key indices that most investors likely have. So stocks in the US, stocks in Europe and Japan in the middle, and then stocks in emerging markets, India and China, as you can see. They track the 2025, how much earnings grew by. And then the next one in blue is how do they expect 2026 earnings to grow by? Ideally, you want both bars to be positive, and ideally, you want the blue bar to be bigger than the gray bar. What do you notice? You notice that both S&P 500 and emerging markets have fairly strong earnings growth. Remember that AI story I talked about and the profit margins I showed? It is translating to higher earnings. In fact, I was just sharing with Lindsey prior to starting this call that the S&P 500 is expected to grow its earnings in the first quarter of this year by 12%. And if it's realized, that will be the sixth consecutive quarter of double-digit earnings growth. It is anticipated to grow by 18% this year. Again, a lot of it coming from that AI narrative, as well as some of the other companies. But it's hard to sort of slow the equity rally in when we see such strong earnings growth. On the left-hand side, we sort of remind investors who often tend to be very US domiciled. We live here, I recognize that, and it is the biggest component of the global stock market. What we're showing you on the left-hand side is how is the global stock market composed of? US is a big component, but let's not forget that international markets, which has seen, again, this momentum from last year continue into this year, is also showing signs of sort of new growth, which is why investors have sort of leaned in. And that represents roughly 35%. So sort of not having international is something to be mindful of. What about bonds? In regards to bonds, the narrative really shifted, and it's sort of like just like the stock market, the bonds don't get talked about as much. But in terms of interest rate cuts to hold, to hike, each day has been sort of a big drastic change in how markets have thought what the Fed would do. So starting with the left-hand side. You could see a month ago what the markets thought we would get was mostly some type of a cut. And then we went to say probably no cuts, more like a pause until we see how long oil prices stay elevated and what the impact is to inflation. The Fed is unlikely to move. For a moment there, during the peak of the war month during March, we saw markets almost price in rate hikes. That's not our base case, but and you can see the markets have quickly retreated from that. But in this backdrop of should the Fed stay on hold, how should investors invest in the bond market? And that's what we're looking on the right-hand side. Today, bonds to me are sort of like broccoli. Nobody says, oh, I want to have an all broccoli dinner. I apologize if there's someone of you in there, but I think of bonds as broccoli because they're sort of the income or they're the healthy part of the portfolio for diversification. It gives you a sort of a known yield, and the yield is fairly reasonable, or the income is fairly reasonable. It's when you have a higher starting yield, the movements in interest rates tend to create what we call as this asymmetric return. So take a look on the right-hand side. If interest rates did nothing, you get 4.5% or so, 4.2. I'm rounding for ease of conversation. But if interest rates were to drop 1%, the price appreciation could give you almost 10%. That is not our base case. But even if interest rates rose 1%, because let's say inflation fears come back strongly, and for those that are worried, this is going to be 2022 when bonds struggled alongside stocks. That's not the base case today. Today, because of higher starting yields or income levels, the hit to bond prices is limited, again, creating this nice asymmetric. So we think of bonds as the ballast and the income within our portfolios. With gold, I mentioned this narrative we saw during something took investors by surprise in a way, in that gold prices fell alongside stocks and alongside bonds. Why would that be the case, especially if gold is historically an inflation hedge and we were worried that inflation was going to rise because of higher gas prices? Here's why. When the narrative shifted, you see that green is essentially dollar. Gold's closest sort of mirror image is the dollar. When the dollar rises, gold tends to fall. And when the dollar falls, which is what it has done for the last 2 years, gold tends to rise. Why did the dollar rise? For one simple reason. If the Fed is not going to cut interest rates, that means our interest rates are more attractive than other countries. Investors flooded back to the US, one. And second, for safe haven reasons. Again, for those that are worried that the dollar is sort of no good anymore, this to me is a prime example of why we still think that the dollar will hold as a reserve currency. We don't think our thesis also changes because you can see on the right-hand side, central banks have continued to buy gold. And so we like gold as a diversifier within the portfolio as well. So even though it took a hit, we don't think the thesis for why gold rises shifts just because of what we saw last month. This is my last chart, and I promise to shut up after this. A reminder that the markets never go up in a straight line. And we also have midterm elections this year, which means that the narrative and the headlines are only going to get dialed up. On this chart here, we show in the blue and the dashed blue of where the S&P 500 ends each year. The dotted bars are when we have midterm years, and then the red dots represent intra-year drawdowns. You can see in 2026, the S&P dropped 9% during the war at the peak, but the average historical drawdown you can see is 14%. So we haven't even quite gotten the average that we typically experience. I would anticipate volatility to remain despite some of the narratives that we talked about, just given the fact that historically midterm election years tends to be a lot choppier until that election takes place, and then it tends to calm down. So with that, on the economy, we see if the oil prices aren't elevated for long, the economy should be okay based on a strong consumer so far, as well as AI spending. The second part is in terms of investor and what we can do. We really do think that balance and diversification are going to be critical. There are earnings are very strong across the US, emerging markets, so making sure you're sort of balanced in those areas. And within bonds, sort of holding some of that for income and balance is also important. With that, let me stop talking, Lindsay. Hopefully, I haven't just gone off the rails here, and see if I made sense, and happy to answer any questions.
Great. Well, thank you. As always, a lot of really good information. I think it's always, you and I look at it every single day, and for our clients, they're sort of saying, "Hey, I picked up bits and pieces." So helpful, but I hear people give me feedback a lot. They're just like, a lot of it goes over my head too. And that's okay. I think every time we have clients listen in on these, they learn a little bit more. And so appreciate all of the different areas that we covered. From an investor standpoint, those kind of final takeaways. Um, we talk about staying diversified and stick with your plan. I find a lot of time the human psychology feels like they need to do something. And a lot of times clients aren't aware of what's happening behind the scenes on their behalf, meaning that portfolio managers are making changes, making adjustments. I like that you spoke a little bit about the, diversification, return to diversification, where we haven't maybe had as much of that in the past couple of years. And so, maybe we could just touch a little bit more on how, even when there is volatility in the market, it creates opportunities, whether that's rebalancing or getting into new holdings that were maybe overpriced previously, sector changes, maybe just a little kind of few points around that. A lot of stuff is happening, even though if the client doesn't necessarily see it or feel it on the surface.
Indeed. So I'll give two things to chew on. One, if you look at 2026, while the S&P 500 sort of hit new highs, the number of stocks that have been beating the S&P 500, if you lift the hood, is 60% of stocks are actually beating the actual index itself. To us, that's a sign of a healthy market where more stocks. In the past, remember we said the Mag 7 or seven stocks were doing all the heavy lifting. That sort of concerns us because if only seven stocks out of the 500 are driving returns and everyone else is sort of asleep at the wheel, it tells me that the economy is not firing on all cylinders. And that's not the case today. So that's part one. When you lift the hood, you really have this opportunity set. It also tells me that's one. The second is smaller stocks. I didn't mention it in this conversation today, but over the last few years, small stocks, which are really, if you look at, we talk a lot about the S&P 500, but when you look at the job market, the labor market, the majority of jobs in the United States comes from mom and pop businesses that are spread throughout the country. And those stocks have really gone nowhere. Why? Because interest rates were so high. And you can imagine, as a small business, you're highly sensitive to interest rates. But as the Fed started to cut interest rates, even though it's gone on pause, as the economy is okay, those stocks have done really well. And that again tells me that we have a different lever in the marketplace. And historically, it wouldn't do well if we're waiting on a recession to happen. So that's another key to watch for. And then the third thing I want to mention is the international markets. As I stated, after 15 years of investors questioning, why do I have this in my portfolio? This is why we own diversification. When Germany says that they are about to spend more money on infrastructure and defense, so much so that the markets are like, I like when countries spend to resuscitate their economies. We want to be investors there. And the same thing with countries like India and China with the burgeoning middle class. So finding ways to take advantage of different portions of the economy. So hopefully giving a flavor of when I read the index, it really doesn't tell me the full picture. You really have to sort of look under and see, okay, where are those opportunity sets? And this is why it's hard to predict, that small caps sort of beaten out big stocks this year. So we want to make sure we are appropriately allocated. And as we see that shift, it tells me something is happening. Let me lean in or adapt as needed. So yes, we tend to share a ton of information, but often sometimes it gets lost of the changes that are being made underneath the surface that may not be obvious. So thank you for allowing me to sort of share a few more nuggets around that.
Another thing that I've been hearing a lot, we talked about this kind of before we started the conversation, you and I were chatting about that there's so much uncertainty and there's sort of this we're braced for what's coming next and just feeling like there's always going to be something around the corner. And that can sometimes stall clients from proceeding with investing. And so if you were talking to someone, I love when I get this clients who or question from clients, I said, is now a good time to invest in the market? We're having more of those conversations of I have a lot of cash, but I don't feel like it's a good time to invest in the market. I obviously have my own thoughts that I share with them. But if someone was coming to you and just saying, Kezia, is now a good time to be investing in the market, assuming I don't need that money in the next handful of years, what would your answer to that be?
I look at it from a few different ways. First, Lindsay's answer is going to be better. So that's the first part. But with that, here's sort of a few things, just sort of the way I think about it. One, I know that cash net of inflation tends to drag. Right? So I know if I don't need this money, and I look at a 2.5%, and cash is currently in that 3.5%, and I pull that forward, I know historically that that is a net negative return relative to inflation. So I want to put that against the backdrop. Right? Often people don't look at cash minus inflation. You have to do that. So that's the first part. The second part is when I see an environment where uncertainty is the greatest, I'm going to lean into that Warren Buffett quote. You sort of, and when everyone is fearful, this is when, not to be greedy, I'm going to change that second part of the phrase. This is when we cautiously build a portfolio that's appropriately diversified, right? So I think uncertainty is the price we pay to get the returns over the long run. If it was truly, if we felt great, I feel extremely uncomfortable as a portfolio manager. It's the complete opposite end. When everyone's like, I want to go all in, that's when I go, well, that tells me there's a bit of exuberance and excess. And now this is where I'm going to give you a bit of a technical math girl answer, so bear with me. When we had asked this question of investors in October of 2025, remember when markets were like all-time highs, everything was great, AI was going to apparently change the world, and we were all in on this. Stock markets were expensive, right? It was hard to be like, let's go all in. When I look at the price you pay for the future earning potentials, that's what we're always doing the math on. What is the price I need to pay today for the future earnings? And it was expensive. Today, even though stock markets have reached new record highs, the price that I pay today for future earnings is less because markets have repriced certain parts of the markets that were more expensive. That gives me comfort to say, okay, I can dollar cost average in to different parts of the markets, and I know the earnings story that I just shared is strong, which is probably a good time as any. Doesn't mean that it's guaranteed to generate returns, but I know that I'm not buying the most expensive time in the market.
Great. Thanks so much for sharing your perspective.
Again, Lindsay's answer is going to be better. So I put that with
Well,
with the full disclosure there.
I always know more about their specific circumstances, so it's maybe more, more information allows me to give a more precise response to that. But the last thing that I guess I'll leave you with is we've been talking a lot about this human psychology piece, and so for those clients that are sort of monitoring their accounts and seeing some of these short-term bigger movements. And then immediately followed by, okay, it only lasted a few weeks and now we've got recovery. We sort of get used to that. And so you and I know that the markets are not always going to recover that quickly. And there will be a time where we have sort of in that chart a bigger dip that maybe lasts for longer. Back to that, things are happening behind the scenes. There's stuff, that's being done in order to help protect clients. Um, not protect, but helping to say, hey, there's a plan behind all of this and why we're kind of continuing to work on it. But just that piece where I'm panicking a little bit, if we look to you and said, if I'm calling you and I'm saying, oh my gosh, Casey, my account's down 10%, what should I be doing? What's sort of the calming guidance that you would leave clients with?
Yeah, it never helps to say volatility is normal. No one likes it. No one likes to be told, take Pepto-Bismol, don't look at it, you know. So I acknowledge that. Now, having said that, I think here's what we look for. There's something what we call as regular market gyrations. No one likes it, but it is sort of the normal course. If it was this way, you'd get the CD rates, right? There's a reason why stock returns are much higher than your CD and or your cash rates. But here's what we really look for. Are the roller coasters, are there some cracks in the foundation of the economy? And when those things happen, you see those large drawdowns. And we typically look for some what we call as financial system crackdowns. But think about the 2008, right? When the foundation of the economic principles around the globe cracked. Are those things developing? Because those are the things we want to avoid. When we, typically say stay the course, it's for this, not for that. That you want to try and sort of step away from for as much as we can. And today, when I look at the foundation of the overall economy, is there a big bubble forming? Now, you could say, let's start with the consumer. No, the consumer has sort of, yes, we talked about the lower income cohort, starting to show some cracks, but the rest are actually employed and doing reasonably well. You own stock portfolio, it's sitting on record highs. You also own homes. They're also holding value. And so you could see that there's no 2008 like cracks. What about the markets? Is this a bubble? Is the AI technology a bubble? When we saw markets drop nearly, some of the software companies saw 30 to 50% drop without the top line moving. You didn't quite see what was happening underneath. To us, when they drop 30 to 50%, that tells me that the system is auto-correcting and that we're not sort of setting new bubbles like we saw during the tech crisis, where you could be pets.com and apparently you were a finger puppet company making zero money and your stock prices were completely disconnected from reality. We saw the markets readjust. So the whole point being, when we look for large bubbles, there may be some corrections. That's not the base case today, which tells me that the overall state of the economy is reasonably healthy. Now, it doesn't mean that it is completely invulnerable to shocks like war, like an oil extended shock. But those are the things we're watching for, right? The roller coaster, it's very hard to avoid. Like it's very, very hard to avoid. But if we see those deeper drawdowns, which typically happen as a result of financial excesses, and if we don't see those forming, then to me is often to say, okay, how much Pepto-Bismol do I have? And how often should I not look at my account? And let's go. Something along those lines is sort of how we look at, when to invest and how to invest. Hopefully, super long-winded answer, but giving some context behind normal pullbacks and sort of these crises that develop. They are two different things, and often we mix them as one.
That is super helpful. Thank you so much for your time today, sharing all of the information from AssetMark's perspective, and then carrying the conversation beyond a little bit further to just kind of talk through some of those feelings that we all have at various moments when we're riding the roller coaster of investing. So, Casey, I really want to thank you for your time. Thank you, everyone, for joining today. And we'll look forward to see what the next quarter brings and recapping that once we're on the other side of it. So thank you so much. Have a great afternoon.
Take care.